We're speaking on Tuesday, the 26th of September, and the stock markets are having their worst single-day drop since March, with the S&P 500 down more than 1.5%, the Nasdaq down about 1.6%, and the Dow, as of closing time, has dropped about 400 points. Milton Berg is here to break down exactly what is going on and what is likely to happen next with the markets. He is the CEO of MB Advisors, an institutional research service. Milton was on the show a few months ago, back in early July, and he has successfully called the top in July. When we spoke a few months ago, he anticipated the top to happen around later in the month, and it did. Milton, welcome back to the show. Congratulations on a great call earlier this summer.
David, thank you. Nice being on the show today, especially these very interesting times for the market.
Very interesting indeed. Let's start by talking about what happened today, and then we can revisit your call from earlier this summer. Like I said, you've correctly called for the top in the stock markets. We've had a bit of a decline since the beginning of August. Today, some economic data that came out spooked the markets, apparently. Now, new home sales dropped. It came out lower than expected. The previous number was 739,000. Today's number came in at 675,000. The median forecast was 695,000. Consumer confidence also came in a little bit lower than expected. Investors and traders are seeing this data and perhaps looking at this and seeing a deterioration of the economy. Is that the cause for today's sell-off, do you think?
Not necessarily. As you know, historically, quite often when there's weak economic numbers, the market rallies because the market is anticipating a change in Fed policy or a continuation of Fed easing when there's weak numbers. So you really can't use fundamental data to tell you why the market moved up or down on a day. But the trend has been down since July 19th or so, or July 31st, depending which index you look at. This is just a continuation of that downtrend. Now, the reason the market is down today, of course, people will like to blame it on the news of the housing market or other fundamental news they have. But basically, if the market is going to correct significantly because there's a recession, or let's call it an unexpected recession ahead, then, of course, when negative news comes out that is unexpected, it's going to affect the market negatively due to the fact that it's unexpected. Now, all negative news is truly unexpected. And the reason being is, as you know, back in mid-July, one of the great, I don't want to mention names of other analysts, but one of the great analysts and one of the great major investment banks who was predicting a 65 to 70% chance of a recession a year ago, just lowered it to a 15% chance of a recession. That's just a sign that the sentiment shifted dramatically. When the market was declining last year ago, June 2022 to September 2022, October 2022, Nasdaq making a low in December 2022, it's a market that caused analysts to suggest a recession is up ahead. In other words, they're saying the market is going to go lower because there'll be a recession. What they're really saying is the market is down, and therefore we have to find the reason for it, and we have no evidence of a recession yet, so the recession will probably be ahead of us. And now that the market gained significantly off the December lows of last year and off the October lows of last year, same analysts say, well, if the market is up and we don't see a recession, that means there won't be a recession in the future. We don't look at things that way. The market basically moved down last year, probably because of a combination of the Ukraine war and perception of Fed tightening. We don't believe that the Fed was really tightening because on a real basis, interest rates were still quite negative. It was quite negative. Interest rates were not positive on a real basis. Just started turning positive in May and June of this year. Even the yield curve was based on negative yields, negative real yields, which is not historically with a yield curve forecast a recession. It's a yield curve using real yields rather than negative yields, positive yields. It's only in May that you started seeing a yield curve based on real interest rates. So therefore, we think that the Fed tightening is only starting to bite. Just started biting now in July, August, September. We think there's a high probability there's a recession ahead. But my job isn't to call recessions. My job is to call market movements. And back in June, July, August, there were classic signs of a market top. And that's when we turned negative at that point. Now, again, we're traders. We don't necessarily going to call a top and remain short. We actually were forced into the market on August 29th. We had a number of buy signals, but they were violated in mid-September as the market continued lower. And now we're short again. And I could give you a little headline of what we're doing, but it's probably best to describe it a little later. We're about 50% short. We can go as high as 175 to 180% short. We think there might be a very sharp short rally ahead of us sometime in the next week. If it's a sharp rally lasting a couple of days, let's say 1 to 7 days, we would like to short that rally, and we'll probably get to 175% short if we don't get any buy signals accompanying the rally that we get. But we are expecting a rally. I can tell you why if you'd like to discuss that.
I do want to get to your positioning and your outlook in just a bit, but I'd like to revisit your July call. Again, you've been on the show earlier in July. We spoke exactly. We published our conversation on the 15th of July. Back then, the S&P was around 4,500 points. We were calling for a top. I'd like to have you please explain to the audience what it is you were looking at exactly back then in July that signaled to you that the markets were topping, because that was a good call.
Okay, number one, we looked at all blow-off tops in the past. Now, as you know, back in July, most analysts, both fundamental analysts and technical analysts, were projecting the market to continue higher. Basically, since the market had already gained off its lows, it should continue higher. The way we do our work, no reason for market to continue higher just because it has been rallying. It doesn't work that way. We analyze sharp short-term moves. We saw that the S&P gained 12.12% in 43 days from May 23rd. We saw the NDX gained 17.38% in 37 days from its low in May, and the Russell gained 15.36% in 41 days and 9.85% in 17 days. This fits in with the parameters seen at blow-off tops at final highs in bull markets. So while the typical retail investor, or even institutional investor who just looks at market action, hey, it's a strong market, it's going higher. We said, hey, it's a strong market, but the type of concentrated gain you saw is the type you saw at blow-off tops. And the sentiment was in line with that because, as you know, the sentiment in July was more positive for the market than it was in November, December of 2021. So that's another thing we saw. We saw signs of a blow-off top based on market action and a sign of blow-off top based on sentiment. However, there's much more to the reason to believe a market may be topping. Number one is the semiconductor index, which was the darling of the market. I think the semiconductor index gained some 85% or so off its lows of October 2022. But we started seeing a series of upside gaps and downside gaps. Now, as you know, gaps in stock indices, even in individual stocks, but certainly the gaps in stocks indices are not randomly distributed. There are three types of gaps. There's a gap that takes place at a turning point. In other words, at a top, the market would gap up, would gap down, signaling a top. It takes place at the bottom, and the market gaps down into a bottom and gaps up within a few days of the low. And then there are continuation gaps. There's no evidence at all these look like continuation gaps. But there were signs that this was the final gap ups in bull markets. Let me tell you what we saw in the stocks, for example. You saw an upside gap on May 25th, May 26th, June 13th, June 30th, and July 27th. Upside gaps are signs of an emotional market. It's not a sign of a rational market. It's not a sign of a standard market move. It means that people, I guess they call it FOMO, fear of missing out. I just say it's an emotional indicator. People feel they got to buy regardless of price. So you saw a series of upside gaps. But accompanying these upside gaps was a series of downside gaps in the stocks, for example. I use that index because you try to get a sampling. The stock index is the one that had the most, let's say, the most emotion, the most positive sentiment because of the NVIDIA and so on. So you have the downside gaps are May 31st, July 6th, July 12th, July 13th, July 20th, August 2nd, August 8th, August 11th, and again September 7th and 21st. Now, when you get upside gaps into a high, a corrective high, or even a bull market high, followed immediately by a downside gap, this is a characteristic of a market top, and you saw that in the stocks index. So the idea that you saw so many gaps in the upside and gaps in the downside told us it's an emotional market. It's not trading in a rational manner. It's trading in a manner that generally leads to turning points. Same now, just to point out as far as these things go, the NDX, for example, generated a downside gap on July 20th, one day after its peak. Now, if I can share a chart with you, let me share a chart with you. Okay, as I said, gaps are not randomly distributed. When you see a downside gap within days of a market peak, especially when it's preceded by upside gaps into that peak, that is a characteristic of a very important market top. For illustration, I show this to my clients. The Nasdaq peaked on July 19th. It gapped down on July 20th, one day past the high. So you had a day one downside gap which was not filled, one day past a high. Now, the Nasdaq was up some over 45% at that point off its lows. Now, you saw two successive upside gaps on July 12th and 13th, which were 6 and 7 days before the final high. So again, 6 and 7 days before the high, you see upside gaps, and people got running into the market. And all of a sudden, one day after the final peak, you see a downside gap. This is very, very reminiscent of the kind of peak you saw in the NASDAQ in the year 2000 prior to the great bear market of roughly 78, 80% in the NASDAQ. NASDAQ peaked on March 10th. It gapped down on March 13th, which was one trading day past the high. And it had two successive upside gaps on February 29th and March 1st, 8 and 9 days before the final high. So currently we had the two upside gaps 6 and 7 days before the final high. In the year 2000, you had the final upside gap 8 and 9 days before the final high. And in each instance, you had a downside gap 1 day off the high. Now, this is just one of the things we saw, because as I said, we saw a series of gaps into the highs in NASDAQ and off the highs in NASDAQ, into the highs in stocks and off the highs in stocks. And in fact, we also saw similar action in the S&P 500. We saw far more gaps than you generally see on the up as the market was rallying, and you saw gaps to the downside. Of course, today was a downside gap day as well. So this is another reason we started turning negative in July. A, we saw the blow-off type action. B, we saw sentiment. 3, we saw the emotions showing up in upside gaps and downside gaps and the reversals. There's also a large reversal, as you know, I think it was July, let me get my Bloomberg, on July 17th, I believe. See, I'll show you this chart. This day right here was a technical reversal day. This is July 17th right here. Let me just zoom it up. July 17th was the final intraday high in the S&P 500. It gapped to the upside on the final day, on this final day high, reversed down 1.70% from high to low. This was the final intraday high. The closing high was in July 31st. The intraday high was on July 27th. And the Russell, its closing recovery high is actually on July 31st. But this is also a technical sign, this type of reversal. So into the high, we last spoke, in early July, and we were anticipating the top, of course, of all the gaps, but the market continued acting as it does at major market peaks. This is the S&P. You see the gap right here. You saw upside gap July 12th. And you saw a downside gap on August 2nd, 2 days past the low. So you also have the same characteristic. One upside gap a number of days before the final high, and one downside gap just 2 days after the final closing high, which is very, very significant. So now this is just a technical. There's a lot to speak about on a fundamental basis. On a fundamental basis, obviously, as I say, whatever reasons people were looking for a recession or depression or deflationary situation back a year ago, there are far more reasons to be negative about the economy currently. Far more reasons. You have the yield curve is far more inverted. The long-term Treasury was 3.75% a year ago. Now, what is it, 4.75%? You have real interest rates which are starting to bite. You have consumer sentiment, or let's put it as a market sentiment at previous peaks. And there are very other fundamental type indicators that have started to roll over, that normally roll over during a recession. Again, I'd rather focus on the technicals, but on a fundamental basis, the kind of things we look at, leading indicators, employment rate, quits rate, jolts, and so on. All these things are acting as they act prior to recession. Now, just because there'll be a recession doesn't mean the market's going to go down. If the market had anticipated a recession, it's fine. But now we're coming off a 48% rally in the NDX, a 28% rally in the S&P, an 80% rally in the stocks. So you can't say the market was anticipating a recession. The market's anticipating a further boom to the upside. And if you're not going to get that, you're going to see a decline. So that's just a little bit of what we've.
Well, Milton, just speaking of recession indicators, you mentioned the yield curve. What does the rise in, let's say, the 10-year yield, we're talking about bond year now, the 10-year yield indicate to you? Does that indicate to you optimism in the economy? I mean, usually when the long end of the curve goes up, doesn't that mean traders are anticipating some sort of economic recovery or some sort of boom? That's why they're selling bonds and buying stocks?
Well, there are many reasons interest rates move up. When a junk bond or companies near bankruptcy, interest rates go up. Nothing to do with the fact that people are positive about the economy. Basically, they're not so positive about the company paying its loans. So, the United States really can't pay off its debts. The United States has been defaulting on its debts for a number of years already, because when the Federal Reserve prints and inflation reduces the value of the interest you're receiving on bonds, that's in fact a real default. They don't call it a default, but if I invested in a treasury bond 20 years ago and they promised 6% per annum, and my 6% is now equivalent to 4.5% or 4% due to the inflationary effects, that is a default. And it's not just an accidental default, it's an intentional default on the part of the Federal Reserve in conjunction with the United States government. So they have been defaulting, but it comes to a point where they can no longer inflate, because they would inflate. Believe me, Powell and Biden would inflate as much as they can. The problem is politically they can't. They don't want to lose their jobs. I mean, they don't want the Democratic Party to get out of power. So they desperately have to fight inflation. They don't fight inflation unless they're desperate and they're forced to fight inflation, because governments love inflation. It's just, again, it's a way of defaulting on the debt. So now that they're forced to fight inflation, that's another reason why interest rates are moving up, because the money supply is tightening, and the United States has to honestly try to pay off its loans, and they can't pay off its loans. They're really nearly 300% debt to GDP. If you look at off-balance sheet debt in the government, they're spending like they say, like they're drinking, like they're spending the way drunken sailors drink. So there are potential fundamental problems ahead, and the fact that the Treasury bond is rising, yields are rising, does not tell me that the market is expecting economic growth. It's telling the market is expecting difficulties for the United States to honestly pay their debts.
All right, Milton, so you were talking about a top earlier this summer. Now, the S&P 500 has corrected about 5%, give or take, from its top to today's levels. Do you think it's done correcting then?
Wow. You say 5%. Let's see. The Russell, the stocks has corrected 14.47% from intraday high on July 31st to today's intraday low. So that's a little more than 5%. But it's very important to monitor the S&P's correction. On a closing basis, the S&P has actually corrected 6.87%. Now, let me tell you why that is important. And this is something people don't realize. We've looked at every bull market in the S&P 500 since March 4th, 1957, when the S&P was expanded to 500 stocks from 90 stocks. So we look at, most of our data begins in 1957. There's only been one bull market of the more than 20 bull markets that took place since 57. In only one were there more than 7% corrections in the first year of the bull market. Okay? In other words, we've already had 7% corrections in this bull market. We've had a correction of, let's see what we got here. We had a correction of 7.75% into December of last year. And we have a correction of, into March of this year, got a correction of 7.20% in December of last year. And now we have a correction so far of 6.87%. We get above 7%, that is not consistent with what you see during the first year of a bull market. Just not consistent. We should tell you that this rally is a bear market rally, and probably the 7% will continue down to 8, 9, 10, 15, 20, wherever it's going to go. This is something most people don't notice. And the only one, I don't have the data in front of me, but the only one instance where the market, the S&P corrected more than 7% three times in 1 year, it was fractionally above 7%, like 7.01% to 7.10%. I don't remember the exact number. So if this correction continues lower before October, roughly October 11th, which would be the third correction greater than 7%, which already tells you that this bull market is not similar to previous bull markets we've seen in the past.
Okay. Is that why you think if there's going to be a short-term rally, you're going to be shorting it?
Well, that is one of the reasons. I don't anticipate the indicators. Right now, we haven't been down 7%. We're only down 6.87. If we're down another 0.5% tomorrow, and we'll take us down to 7.2, I'd say, yes, this is an indication that we're no longer in a bull market, or we're never in a bull market, possibly, and I would short the rally. But there are many other reasons why I'm going to short a rally that takes place. I can give you the reasons now. Basically, this is the story. We're in a very serious time frame. We have record debt to GDP, number one. You have a record number of zombie companies in the S&P 1500 and in the Russell 2000. You have major divergences that you've never seen before in bull markets. For example, you're seeing the S&P 500 at new highs in July, while the S&P 1500 and the S&P and the Russell 2000 and the S&P small caps and the S&P mid caps basically peaked in February. I mean, there's some double tops. The mid caps double topped in February 2nd to July 31st. But in reality, the fact that the S&P was up over 9% above its February 2nd high, and the Nasdaq was more than 17% above its February 2nd high, and the rest of the indices were lagging, is a very, very poor indicator. Because when you see indications of divergences where the S&P is making new highs and Nasdaq is making new highs, but many indices are not making new highs, that is very, very negative. It's a very negative divergence. Also, this has been one of the weakest markets we've ever seen, one of the weakest bull markets we've ever seen. I know many people are saying, we actually had one of the strongest bull markets we've ever seen. But in reality, we have one of the weakest bear markets we've ever seen. Let me just share this screen with you.
You mean one of the weakest bull markets?
Bull markets we've ever, yeah, this is one of the weakest bull markets we've ever seen,
Right.
as opposed to
Okay.
saying one of the strongest. Let me share a screen with you.
Yes, please.
So as you can see, it's now day 238 since the market bottom, 238 days since the market bottom in October 12, 2022, right? Of all bull markets that lasted 238 days, we have the weakest return. We're up 21.26%. 2020 up 70%, 2018 up 32, 2016 up 23, 2011 up 30, 1984 up 29, 1971 up 23. You see, we have the weakest gain to day 238. Now, the reason is so it's the weakest bull market if we're still in a bull market. But most likely, the bull market wasn't even a bull market. We peaked on, we peaked on day 199 of 28.29%. And it's quite possible that was a bear market rally. And if we were in a bull market, this is still the weakest bull market ever, which is a cause for concern. Because when you say you're in the weakest bull market ever, you have to ask yourself, well, maybe it's not even been a bull market. Maybe it's just been a bear market rally, strong bear market rally. And there's precedence for that one.
Okay. So bottom line now, Milton, are you saying that the probabilities are in favor of a further correction from here versus the probabilities of a major rebound from current levels if you had to weigh the probabilities?
Yeah, well, if I had to weigh probabilities, I think that the most likely scenarios that the bull market peak is in. Most likely scenario that we've seen the peak in the bull market. Now, I have to really, this has been a change of view, because when the market corrected in July, the market corrected some roughly 4% and change in the S&P from its July high to its August 18th or so low. That gave us characteristics of what we call the get ready to sell signal. In other words, we've looked at previous bull market peaks, and at previous bull market peaks, the market declined somewhat around 5%, then rallies back up to new highs, into a final high, and then the bear market begins, or then the bear market decline begins. In this case, when we declined that 4% or change into August 18th, we thought it's a get ready to sell signal, and most likely the next rally will take it to new highs. Unfortunately, the next rally did not take us to new highs. It took us to a secondary peak below the high we saw in late July. So it's quite possible we've already seen that initial bull market peak with the initial decline, the initial retracement rally. However, most retracement rallies early in the bull market are stronger than the one we saw currently in the S&P 500. But I'll give you an example. The SOX gained off its August corrective low. It gained 6.89%. The S&P gained some 3.31%. We're looking for a stronger rally than that. Now that the S&P is down some 7%, if it gets down another 2 or 3%, down 8, 9, 10%, we probably would expect a 5, 6, 7, 8% rally in the S&P 500. Convince people that the bull market is still in force, and that's probably where we're going to increase our short exposure. We're not happy being 50% short when we're anticipating a bear market. We'd like to be 150, 175% short. However, we really have to see market action and pattern analysis. We have to see the market to decline sharply initially, then rally sharply, fail to make new highs, and that's when we're going to get aggressively short.
At what point, Milton, would the stock markets have to decline for you to be comfortable getting back in?
I'm never comfortable getting back in on the way down, because I know that even in the greatest bear markets, there are retracement rallies. But just knowing how markets generally peak, how markets act at market peaks, it's most likely that that rally, a 3.3% rally we saw at the S&P from mid-August to September, is not that early rally in the bear market. It should be a stronger rally, which will probably come from a lower level.
All right. So, Milton, my next question is, if someone were to say to you, Milton, I'm going to take a look at the S&P 500 chart on a 5-year basis, going back to 2019. And I can see that on a 5-year basis, we've had corrections, we've had dips, but the longer-term trend is up. And this 6.5%, 7% correction that you were talking about since the middle of the middle of the summer really isn't a big deal in the grand scheme of things. The longer trend is still up. We're still in a longer term bull market. Would you agree or disagree with that statement?
I would say that question is asked to me many times, and those questions are asked by people who do not have a background in market analysis or technical analysis. Let's just understand that every great bear market begins with a 5% correction or 6% rate. The fact that we're only down 6% does not tell you anything about the nature of this correction, because it may ultimately be a 99% correction. How do we know? The fact that we're down 6%, but you're looking at a chart 5 years. I'll tell you what you see in 5 years. I look at a chart for 45 years, for 40 years. And let me bring up a chart for 40 years right now. I'm going to share a screen with you. And I'll show you what I look at. I'm going to look at the 30-year generic government bond. And I'm going to show you what I'm looking at. I'm going to go back let's go back to 1980. Let me share the screen with you. So share the screen with you. Let's do that. We are sharing. I'm sharing the screen right now. I see, right? This is the great bull market in bonds. It began when the bonds were yielding roughly 15.25% in 1981. It ended in 2020, about 3 years ago, when the yields were below 1%. Yields were 0.98% or so on, right? The background to the great bull market that this fictional retail investor is asking me about, the background was a great bull market in bonds as well. As you know, conventional fundamental analysis believes that the stock market is a discounting mechanism. And the discount rate they use, or the logical discount rate to use, should be the rate of the long bond, because the stocks are actually a longer asset than the long bond. The long bond is a 30-year asset, and the stocks are a perpetual asset. So if the fact that you saw a major decline in yields from 1981 to 2020 was a great, I guess you call it I don't know what they call it, a great force propelling stocks to the upside, because the discount rate, the long-term discount rate for stocks is declining. Now, over the last 3 years already, you're seeing interest rates rising. You no longer have that backdrop that you expect to have during bull markets. This is enough of a reason to say that the last 5 years, what you've seen in the last 5 years, is not typical, or shouldn't be typical. You see a major bear market correction beginning in 2021. The market hasn't retraced back to those highs. You have the weakest bull market you've ever seen in history off the October lows. You see major divergences with the small cap indexes, with some foreign markets. You see China, you see Hong Kong rallying 50-60% off the lows and immediately retracing a significant portion of that, which you don't see during bull markets. So we're not in the kind of environment we've been in the last 40 years, 50 years, 60 years. And you can't say that just because we're down 6% is a typical correction. You can't. By the time it's down 30%, you can no longer benefit from the fact that it's not a typical correction. That question is not a question when I get this kind of question, basically they're missing the point. You have to see, what did the market show you at its top? At its top, it showed you high interest rates. It showed you high real rates. It showed a Federal Reserve was tightening. It showed you gaps to the upside, gaps to the downside. It shows tremendous positive sentiment in the stock market. And these are the kind of things you see at top. Plus, you see none of the markets able to make new highs above their 2021 highs, despite being 1 year in a new bull market. So it basically should have made new highs. So I would say no. That's the last 5 years or the last 40 years in the stock market. I could show you the same chart in the S&P for the last 40 years, and you'll see, basically had a bull market. That's true. But 1980, look, you have a tremendous bull market in stocks with some major bear markets, but tremendous bull market. And so remember, this all took place. It all took place as the bond market was also having a historic bull market. So now the bond markets are no longer having the historic bull market that has ended. No longer reason to expect the kind of bull market you had from 1980 to 2021 to continue.
Final question on the stock market, and I want to move on to oil because I know you've done some analysis on the energy markets as well. Milton, we know that this year the Magnificent Seven stocks, the tech stocks, the larger tech stocks have pushed up the overall S&P and NASDAQ indices. What if someone were to say to you, well, Milton, I understand your analysis from a technical standpoint, but it's possible that the semiconductor stocks and tech stocks still have more bull in them because of fundamentally their stocks are still sound as an investment. How would you respond to that?
Fundamentally, they may be sound investments, but fundamentally they're probably way overpriced. I didn't. I myself didn't do valuation analysis in semiconductor stocks. I didn't do it, but from what I've heard, it seems to be that some of these semiconductor stocks, especially Nvidia, are trading to far greater extent than the dot-com stocks traded back in the year 2000. Now, some of the dot-com stocks, the best example is Amazon lost 90% from 2000 to 2003. And yet earnings continued going higher and higher. So, maybe the semiconductor stocks have a great long-term ahead of them, but that tells you nothing about the next 2 years, especially since they're overvalued. Now, you can't trade the market or trade stocks based on overvaluation alone, because overvaluation, people get killed.
Well, let's talk about that for just a minute. If someone were to say to you, well, I think that certain tech stocks or large companies are going to push up the entire index, so I'm just going to trade a few of these stocks and hope that they're going to push up the entire market. That's my strategy. How would you evaluate that strategy?
I'd say, if you want to invest based on hope, you can do that, but I wouldn't do that. At every bull market peak, there are some great leaders that led the market into its peak, and probably semiconductors is one of those indices that led this bull market into its peak. That's probably the case.
Let's talk about oil now. It's up about 35% from its lows in the summer. Magnificent run here. Can we just examine the technicals and get your take on whether or not this momentum is likely to continue in the short to medium term?
Well, we do some work called cycle work, and we went short the oil stock. We're about 78% short the oil stocks. We got short because we had what we call a cycle peak. You have to understand oil stocks, the price of oil and the price of oil stocks were not able to reach its peak of a year ago. Let me see XOP equity. Let me just show you. We're short this particular index. Let me just bring it up and I'll share the screen. Okay. This is the. Let me go back to 2021. Make it a little longer screen. But this is the bull market peak on June 8th, 2022. And you had the bear market ended here. You had initial gain up until November 11th, 2022. So you had a gain from July 6th to November 11th, 2022. And now it didn't even manage to get above its initial bull market peak. So this is a secondary rally that failed to exceed its first high. So the optimistic people are about oil stocks. Right over here, we have what we call a cycle date, which is a subject in itself. But in the month of September and October, we have a series of what we call Montgomery. Paul Montgomery was a great market analyst who discovered certain cyclic periods that turn markets, and we're at that period now. This particular high in the XOP occurred on a cycle date, and that gave us confidence to short and one day past that high, and that's why we're at 78% short. Just look at this chart. You see this gap down, right? 3 days. Looks like it's 2 days after its final high. You see, this is the kind of technical thing I was talking earlier. You're looking for precise indications of a market peak. So you had a downside gap just a couple of days after its peak, and in the oil stocks, and that was a sign of that peak. So we're short oil stocks on a fundamental basis. I don't believe that oil is headed to the sky. I think when oil prices get up, it will get too high. People find ways of reducing their usage of oil. If they drive cars, they go to electric cars, or they just don't drive it as often, and so on and so forth. Oil is very, very cyclical, and we see signs of a cyclical top. If we're going to head for a recession ahead, of course, in any recession, the usage of petroleum products declines, and that'd be a reason to be negative on the oil.
So you're short oil, to sum up, you're short oil stocks, and you see potentially more downside for the overall stock markets from these levels. Is there anything you've looked at that is not overbought, Milton?
Well, on a technical basis, I'd have to say the banking stocks are not overbought. The regional bank. Look at the BKX index. Let me do that. You still see the screen, I imagine, right? The BKX index is right here, which is the KBW bank index. See this low right here? This low was a panic low. I mean, the market declines of 20% in a few days into that low. So technically, you want to see a panic low, right? Down 18.12% over a 11-day period. That's a panic low. That's like a crash type low. The initial low took place here. And then the second, the tested low took place here, and it just panicked and reversed. You can see the gap into the final low. So we actually turned bullish around here. It was actually a cycle date. One of Montgomery's cycle dates on May 4th is when it bottomed. But we're not happy with the action subsequent to that. You had a nice gain off this low. And now we think maybe these banks are telling you, even again, 28.64% in a short period of time. Now it's headed lower. It's heading lower along with the S&P. But we have a chart to show you which suggests to us that this banking index is sort of a canary in the coal mine. This won't be the final low. And this low is actually suggesting that there's going to be a major dislocation in the banking sector. Now, we can understand why there'll be a dislocation in the banking sector. And that is because the great bull market in bonds ended with 30 years yielding less than 1%. Banks are major purchasers of bonds, as are endowment funds, as are retail investors. And the fact that you see the great increase in yield from less than 1% to 4.4% basically shows that there are billions and billions and billions, or maybe even trillions of dollars underwater, which is something you haven't seen historically. You haven't seen this type of market dislocation, this type of market deflationary action in the bond market in the history of the bond market. You've never seen it. I know one of the great analysts showed a chart of the 1800s. There was 1 year in which bonds did worse than it did last year, but the following year the bond market zoomed. We're in the second year of a bear market in bonds. Never in history have you seen this type of a bear market in bonds over a 2-year period, which means there are many people underwater, including the banks. Of course, the SVB, the Silicon Valley Bank didn't hedge themselves properly, and they were basically caught with the pants down. But I think there are many banking institutions, many other endowment, pension fund institutions caught in the same problem, which will probably cause some problems in the future. Now, I'd like to share a chart with you on this, which is really one of the things we found was very unique. This is a chart of the S&P 500 versus the KBW Bank Index, S&P versus BKX. Now, as you can see the chart? Basically, when the S&P generates the bear market bottom, banking index generates the bear market bottom basically the same date or 1 day apart. And I'll give you have the data here. The S&P bottomed on October 9, 2022. The banking index bottomed the same day, October 9, 2022. S&P bottomed on March 9, 2009. The banking index bottomed on March 9, 2009. The banking index, however, in the current situation, the banking index declined another 24% below the S&P's low. S&P bottomed on October 12th, 11th, and 12th of 2022, and the banking index bottomed on May 4th, some 24% below that. So this is really the first time in history they see bull market in the S&P, a bottom of the S&P, unaccompanied by the bottom in the banking index. You can analyze it one of two ways. You could either say, hey, the banking index really got oversold and it's going to be great for the banks, which is what on a technical basis what you would say. Or you can say, these banking index should have bottomed the S&P. The fact that it didn't bottom the S&P tells you the S&P bottom is not really a bottom yet. And the S&P, this rally you see in the S&P is just a bear market rally, a retracement rally, albeit a strong retracement rally. And ultimately the S&P comes down along with the banking stocks to make lower lows sometimes in the future, probably not the near future, but probably in the distant future.
Final question, what would change your mind on your outlook for the stock market? In other words, if I were to present to you a case for the stock markets reaching new highs by the end of the year, just hypothetically, what indicators would you have to look at to support that case?
Okay, number one, the stock market will always make new highs if the Federal Reserve capitulates and starts printing again. Because historically, you saw in the Weimar Republic, you had an economy falling apart, the stock market was making new highs. You saw the same thing in Argentina, and you saw it in Venezuela. While the economy is falling apart, stock markets are making new highs. Of course, they were making new highs in nominal terms. In real terms, they're not quite making new highs, but they're making new highs in nominal terms. So number one, if the Federal Reserve, just a bunch of people, they could capitulate, they can get pressure, they can decide to print. And if they print, no reason why the stock market can't get higher. I realize the stock market is down more than we think it is because there's been some 14% inflation over the last year and a half. And real inflation, so you have to really discount the price of the S&P by the inflation rate. But in any event, yes, if they're going to start printing, I would say you can see the stock market making new highs, at least in nominal terms, maybe not in real terms. It's similar to what you saw in 1966 when the S&P made its high. It made a number of minor new highs again in 1972, but that was really based on printing, based on inflation. But on the other hand, on a technical basis, there's no reason to believe that the kind of euphoria we saw There is reason to believe the euphoria we saw in July is a final euphoria in this bear market rally. But you can't really measure euphoria. It's quite possible you're going to get even a greater euphoric market sometime in the near future. You can't count it out. But we have indicators that try to suggest when the market's going to rally. Right now, the indicators are negative. We did get buy signals on August 28th, August 29th. They failed. I'm glad they failed because it gives me more confidence on my July call for it to be short. And clients who follow my work can see the kind of buy indicators we get. But at this point, I say if they print, you get the market going up. I don't see any other fundamental reason because fundamentals are really very, very poor. Fundamentals are not, if there's reason to worry for a recession or a depression, there's far more reason to worry about it now than it was a year ago. So I just say basically, no, I think the most likely scenario is the market goes lower rather than higher.
I understand. So bottom line, your indicators show more downside rather than upside in terms of probabilities. Where can we learn more from your work, Milton, and learn more from your indicators?
Well, I'm writing a book, which I thought would be ready this year, but probably ready in the middle of next year, which will go through many of these indicators. It's going to be an amazing book, amazing data insight. But we have an institutional service. It's MB Advisors. Our website is miltonberg.com. Anyone who would like to subscribe, we have a team that speaks to potential clients, and that's really where you can contact us. Occasionally, we do give some information on Twitter, but it's usually not timely. It's just sort of to educate the public, but it's not timely. The only way to get the timely information is through our subscription, again, miltonberg.com or info@miltonberg.com.
Okay, we'll put those links down in the description below so we can follow Milton's work. Make sure to click on it. Thank you very much, Milton, for your time today. Appreciate it.
Thank you, David. I appreciate it.
Thank you for watching. Don't forget to like this video and subscribe.